Imagine it is the 12th of October, 2001. You're a 44-year-old accountant living in Buenos Aires, Argentina. Your name is Eduardo. You have worked for the same firm for 19 years. You own a modest apartment in the Palermo neighborhood. You have roughly $40,000 saved in your bank account. This is money you spent 2 decades carefully setting aside for retirement. You drink your coffee every morning at the same cafe on Avenida Santa Fe. You read the newspaper and you shake your head at the headlines about government debt. Politicians are arguing, but you're not worried. The banks are solid. The government has promised your money is safe. If you have ever wondered why some people walk out of an economic collapse richer than when they walked in, stay with me. While others lose everything they ever saved, what you are about to hear is not a theory. It is a pattern. It has happened before. It has happened in Germany, in Zimbabwe, and in Argentina. In Lebanon and in the United States, it always ends the same way. The same assets rise, and the same people are protected. The same people are devastated every single time. If you find value in this kind of historical clarity, subscribing takes 2 seconds. It keeps you ahead of what most people never see coming. Because on December 1st, 2001, Eduardo walked up to his bank and found the doors locked. The government had just announced something called the Corralito. It was a freeze on all bank accounts. Ordinary Argentines could withdraw no more than 250 pesos per week from their own accounts. The peso had been pegged 1-to-1 with the American dollar for over a decade. Now it was about to be cut loose. Within weeks, it would collapse. Eduardo's $40,000 in savings was about to be worth roughly $13,000 in real terms. His life savings evaporated. Not stolen, not spent, simply erased. And the cruelest part is that it was entirely predictable if you knew what to look for. This video is about the 5 assets that have repeatedly across different countries and different centuries held their value. They actively increased in value when the economic system around them started breaking apart. We are not going to talk about theories or predictions. We are going to walk through what actually happened to real people in real countries with real numbers. And when we are done, you will see a pattern so clear and so consistent. You will never look at money the same way again. Before we go further, there is something important to understand. Most people think economic collapse is a sudden event, a crash, a single moment when everything falls apart. But that is almost never how it works. Collapse is not a fire. It is a river changing course. The water does not disappear overnight. It shifts slowly, invisibly, carving a new path through the rock. The old riverbed looks perfectly normal from a distance. By the time most people realize what has happened, the water is already gone. The pattern is always the same. First, governments borrow too much. Then they print too much money to cover what they owe. Then the currency loses value. Then prices rise. Then trust breaks down. Then the systems that ordinary people depend on crack. The banks, the pension funds, the savings accounts, they all crack. This process can take years, sometimes decades, but it always produces the same survivors and the same victims. And the survivors always had the same kinds of assets. Think of paper money as a promise. A banknote is not wealth itself. It is a government's promise that the piece of paper is worth something. When a government breaks that promise, either by printing too much money or by defaulting, the paper becomes worth less, sometimes much less, sometimes essentially nothing. The assets that survive this breakdown are the ones that cannot be printed. They have their own inherent value that exists outside the promise of any government. And history has given us a remarkably clear map of exactly what those assets are. This brings us to the first asset, and to the most dramatic economic horror story of the 20th century. It is January 1919. You are a middle-class shopkeeper in Berlin, Germany. 1 ounce of gold costs you 170 marks. Your savings are in marks. Your pension is in marks. Your whole financial life is denominated in marks. You are perfectly comfortable. Germany lost the First World War and owes enormous reparations payments to France and Britain. But politicians assure the public that everything will be manageable. Germany will grow its way out of the debt. Things are under control. Most people believe them. Then, slowly at first, and then with terrifying speed, things change. The German government cannot generate enough tax revenue to pay its war debts. So it does what desperate governments throughout history have always done. It prints more money. At first, inflation is barely noticeable. Then it becomes an inconvenience. Then it becomes a crisis. Then it becomes something that has no parallel in modern experience. By November 1923, $1 was worth 4,200 billion German marks. That is 4.2 trillion marks. Not thousand, not million. Trillion. Bread that cost 200 marks in early 1923 cost 200 billion marks by November. A student at a cafe in Freiburg ordered a cup of coffee for 5,000 marks. By the time he finished, the second cup cost 7,000 marks. The price had risen in the time it took him to drink the first one. Wheelbarrows were used to carry cash to the bakery. German pensioners found that their entire life savings could not buy a single postage stamp. They starved, literally. Food riots broke out across the country. Law and order broke down. The middle class was essentially annihilated. But here's what almost nobody talks about. The people who held gold were fine. In January 1919, that ounce of gold cost 170 marks. By November 1923, that same ounce of gold was worth 87 trillion marks. The gold did not go anywhere. It did not get more valuable in any absolute sense. What happened is that everything around it collapsed, and gold simply stayed gold. People with even a modest amount of gold could buy property or businesses. They could buy food when others could not. The mechanism is simple and it is permanent. Gold is a physical object that exists outside the banking system. No government can print more of it. No central bank can create it with a keystroke. When paper money dies, gold remains. This is why gold has been used as a store of value for over 5,000 years. Not because of tradition, because of physics. There's only so much of it in the earth, and governments cannot change that fact. The data from the Weimar hyperinflation is sobering. Research shows that gold grew in price faster than the inflation rate itself. While hyperinflation wiped out savings, those who held gold not only preserved their wealth, they actually grew it. In a country where an entire middle class was destroyed, gold owners were in a different universe of outcomes. That is asset number one. Precious metals, primarily gold, but also silver, not because they are magic, because they are finite and portable. Estimates suggest there have been at least 30 major hyperinflation events around the world since 1923. On average, that is roughly one every 3 years, somewhere on Earth. Gold performed similarly in Hungary in 1946, in Zimbabwe in 2008, in Venezuela in 2016. If you knew the purchasing power of your currency was going to be cut in half, what would you do differently today? Drop your answer in the comments. Seriously. This leads us to the second asset, and this one is counterintuitive. It is a piece of paper. It is September 15th, 2008. Lehman Brothers has filed for bankruptcy. Within hours, financial markets around the world are in free fall. Money is evaporating from the global financial system at an incredible rate. In the middle of this catastrophe, United States Treasury bonds start going up in value. Panicked investors from around the world fled to American Treasury bonds. Investors do not want return on their money. They want return of their money. The U.S. government was the one institution that almost everyone believed would pay its debts. This brings us to the third asset, and we travel to Harare, Zimbabwe. By November 2008, Zimbabwe's inflation rate reached 79 billion % per month. $100 trillion banknotes were issued and could not buy a simple bus fare. The ATMs of major banks stopped working because they could not handle the numbers. There was no precedent in modern history for what was happening. And yet, in the middle of this total destruction of the monetary system, something held. The people who survived best were the ones who had access to foreign currency, particularly the US dollar. Zimbabwe's middle class fled the country in enormous numbers, taking whatever capital they could with them. But those who stayed and had access to dollars, even small amounts, found themselves in a different position from those whose savings were in Zimbabwean dollars. Prices in Zimbabwe were catastrophic in local currency, but in dollar terms, goods were often remarkably cheap. A person with even a few hundred US dollars could buy property, food, and goods at prices that were essentially unthinkable before the crisis. The lesson from Zimbabwe is the third asset, foreign hard currency. Specifically, the currency of a country with a stable, trusted monetary system, held physically or in accessible accounts outside the system. This pattern repeats with stunning consistency. In Lebanon's collapse beginning in 2019, the Lebanese pound lost 98% of its value within a few years. The poverty rate surged from 20% to over 80% of the population. But Lebanese citizens who had dollars in cash, who had maintained dollar accounts in foreign banks, who had physical dollar bills stored outside the Lebanese banking system, they experienced a different reality. When the Lebanese banks froze accounts in 2019, the people who had already moved their savings into dollars, into physical dollars, or into foreign bank accounts retained purchasing power. Everyone else watched savings evaporate. In Argentina in 2001, the situation was nearly identical. The wealthy and the well-connected had moved their money into dollar accounts in foreign banks or held cash dollars before the crisis hit. The middle class, who trusted the Argentine banking system, lost a third to a half of their savings overnight when the peso was devalued. Most people will never know what you now know. Most people will keep trusting systems they do not understand, assuming that the promises made by institutions will always be kept. If you're still here, you're not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. At this point, the pattern becomes impossible to ignore. Gold exists outside the printing press. Government bonds in trusted countries become stores of fear. Foreign hard currencies serve as life rafts when local currencies sink. Now observe what all three of these assets have in common. They are all, in their different ways, alternatives to the local system. They are exit doors. When the room starts filling with smoke, they are the routes out. This is the underlying mechanism that unites everything we have discussed. When trust in a local financial system breaks down, people move their wealth into anything that is outside that system, whether that is a metal that cannot be printed, the promise of a more reliable foreign government, or the actual currency of a country people still believe in. The same mechanism, different countries, different decades, same result. In Germany in 1923, the exit door was gold. In the United States in 2008, the exit door was treasury bonds. In Zimbabwe in 2008, the exit door was the American dollar. In Lebanon in 2019, the exit door was again the dollar, held outside the banking system. In Argentina in 2001, the exit door was dollars in foreign bank accounts. The asset changes based on context. The mechanism is always identical. Now, here's where it gets interesting, because the fourth asset is the most counterintuitive of all. It does not glitter. It does not trade on any exchange. You cannot download it or transfer it electronically. And in the middle of a raging economic collapse, it is the asset that almost nobody thinks about until it is too late to acquire it at a reasonable price. The fourth asset is land, specifically productive agricultural land. After the 2008 financial crisis devastated housing markets across the United States and led to widespread job losses across almost every sector of the economy, one category of land did something that surprised everyone. Farmland values soared, not just recovered, soared, while residential real estate in places like Nevada, Florida, and Arizona fell by 50% or more. Farmland values in the American Midwest kept rising. The mechanisms driving this were several. Interest rates fell to nearly zero as the Federal Reserve tried to stimulate the economy, making borrowing to buy land cheaper. The expansion of ethanol production created new demand for corn, significantly boosting grain prices and therefore farm incomes. And institutional investors who had previously ignored farmland as an asset class began to notice that it had provided positive returns through a financial crisis that had destroyed almost everything else. A standardized measure of farmland returns called the NCRIF Farmland Index attracted these large investors and further drove demand. But the deeper historical reason farmland survives economic crises is much simpler than any of that. Land produces food. Food is always needed. Food demand does not go away when a currency collapses. If anything, it becomes more urgent. The farmer with land and the ability to grow crops during Weimar Germany's hyperinflation was, according to contemporary accounts, essentially a king. When German city dwellers could not afford bread at 200 billion marks a loaf, they traveled to the countryside to beg food from farmers. Farmers could name their price in gold and silver and foreign currency and goods. The land kept producing, regardless of what the paper on which currency was printed said it was worth. This pattern appears in essentially every economic crisis in history. In Zimbabwe, the catastrophic land redistribution policy itself destroyed agricultural production and accelerated the hyperinflation. But those who retained productive land and could grow their own food were in a fundamentally different position from urban dwellers. In Lebanon's crisis, as consumer prices rose 240% in a single year between 2019 and 2020, and food prices rose nearly 370%, the people with access to land and the ability to grow food had something no amount of Lebanese pounds could buy: security against the collapse of food import chains. Land cannot be printed. It cannot be created. A government can, in extreme cases, seize it, which is a real risk that history documents clearly. But in moderate crises, in the crises that fall short of full political revolution, productive land is one of the most reliable stores of value that exists. It produces income that tracks inflation because food prices rise with the currency's decline. It has physical reality that paper does not, and it represents a claim on the most fundamental human need that any system of any kind will always require. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. This brings us to the fifth asset and to what the survivors of these crises actually shared. Because the fifth asset is not a thing you can hold or buy on exchange. It is a quality, a characteristic, but it is manifested in a specific, tangible way in every one of these historical cases. The fifth asset is diversification outside a single system. The historical record is remarkably clear on this point. The people who walked out of these crises with their wealth largely intact were not necessarily the people who had predicted the collapse. Many of them had not predicted it at all. What they had done, for a variety of reasons, was hold their wealth in several different places at once. They did not have all their savings in one bank. They did not have all their wealth in one currency. They did not have all their assets in one country. They had, in the language of historians studying these events, distributed their exposure across multiple systems. In Argentina, the people who kept their savings exclusively in Argentine peso bank accounts lost roughly a third to half of their wealth in 2001 and 2002. The people who had, years before the crisis, moved some of their savings into dollar-denominated accounts in foreign banks, or held some gold, or owned property, survived with their wealth largely intact. The wealthy Argentines who had offshore accounts and foreign real estate saw the crisis from a safe distance. It was not that they were smarter or more prescient. It was that they had not concentrated all of their wealth in one system. In Weimar Germany, the pattern was identical. The people who had some gold, some foreign currency, some land, and some domestic assets were damaged by the hyperinflation, but not destroyed. The people who had all of their wealth in German mark savings accounts or German government bonds, the cautious, responsible, diligent savers who had done exactly what responsible middle-class Germans were supposed to do, those people were completely destroyed. Their life savings became worthless. The mechanism here is not financial sophistication, it is structural resilience. When any single system fails, assets held outside that system survive. It does not matter which system fails or how. What matters is whether your wealth exists entirely within it or partially outside it. The Lebanese citizens who had maintained dollar accounts in Cyprus or elsewhere before 2019, who had invested in property outside Lebanon, who held some currency at home, experienced the crisis as painful but survivable. The citizens who had trusted the banking system completely, who had kept their savings in Lebanese pounds and Lebanese banks, those were the ones who watched the poverty rate of their country surge from 20% to over 80%, while they were powerless to do anything about it. The survivors shared three characteristics that appear consistently across every case study in this video. First, they held some portion of their wealth in an asset that existed outside the local monetary system: gold, foreign currency, property, something. Second, they had maintained access to a financial system other than the one that failed: a foreign bank account, a brokerage account in another country, physical assets liquidated internationally. Third, they had not waited until the crisis was obvious before making any of these decisions. By the time the Corralito froze accounts in Argentina, it was too late to move money out of banks. By the time Lebanese banks froze accounts in 2019, it was too late to withdraw dollars. By the time the German mark began its final descent in 1923, it was difficult to convert savings into gold. The window to act is always before the crisis becomes undeniable. This is the truth at the heart of every economic history of collapse. Now let us go back to Eduardo, the 44-year-old accountant from Buenos Aires. We left him with his bank doors locked and his savings frozen in early December 2001. What happened next? The Argentine peso was devalued in January 2002. Eduardo's $40,000 in peso savings were converted at a rate that gave him roughly $13,000 in real purchasing power. Over a quarter of his savings, gone. The unemployment rate in Argentina at the end of 2001 was around 23%. 40,000 companies had shut their doors since the deepening of the crisis in 1998. There were riots. There were deaths. 5 presidents served in less than 2 weeks. For Eduardo, and for millions like him, the experience was a defining wound. Not because Argentina was uniquely corrupt or uniquely incompetent, but because the warning signs had been there for years, and the system he trusted made it easy not to see them. The people who came through the Argentine crisis relatively intact were not financial geniuses. They were people who had followed a simple historical principle. They had not put all of their wealth inside one system. Some had dollars in foreign banks, some had gold, some had property in hard currency, some had relatives abroad with whom they had pooled resources. They had essentially hedged their lives, and when the system broke, they had somewhere else to stand. The 5 assets that history tells us repeatedly protect wealth when economies start breaking are not complex. They are not exotic. They are just outside the systems that fail. Precious metals, particularly gold, which has no government behind it and cannot be printed into worthlessness. Government bonds of the most trusted and stable governments, which become stores of global fear capital in financial crises. Hard foreign currency held outside the collapsing local system, which gives purchasing power when the local currency fails. Productive agricultural land, which generates real food in a world where food prices rise with inflation and whose value tracks the real economy rather than the paper one. And structural diversification, which means holding something outside any single system, so that when that system does what history shows systems eventually do, you have somewhere else to stand. None of this is a prediction. History does not repeat exactly. What it does is rhyme loudly and persistently across centuries and continents. The economic mechanism that destroyed Weimar Germany's middle class in 1923 is the same mechanism that destroyed Lebanese savings in 2019. The flight to safety that flooded U.S. Treasury bonds in 2008 is the same instinct that led Argentine investors to seek dollars in 1999 and 2000 before the crisis. The farmer who could name his price in Weimar Germany in 1923 because land produced food when paper produced nothing is the same dynamic that made Lebanese agricultural land suddenly relevant in 2020 when food prices tripled. The people who understand this pattern do not need to predict when the next crisis will come or where. They simply need to arrange their affairs so that not everything they have is inside a single promise. That is all. Not complex, not exotic. Just structurally sound in a way that history has validated repeatedly. A final note that this channel considers essential. This is historical and educational analysis. It is not financial advice. Every individual situation is different. The assets discussed in this video carry their own risks. Gold can fall in price. Government bonds can default if the government is not trustworthy. Agricultural land can be seized. Foreign bank accounts can be frozen. Hard currency can itself be devalued. No asset is perfect protection against every scenario. This video describes patterns observed in history. It is designed to inform and educate, not to direct your personal financial decisions. Please consult a qualified financial professional before making any decision about your finances. What you do with your money is your responsibility, and it deserves more than a YouTube video to guide it. This video is not for everyone. Most people will watch it and go back to assuming that the systems they live inside are permanent, that the bank will always be open, that currency will always be worth something, that the promises made by institutions will always be honored. But some of you have watched this and heard something different. You heard a pattern, a clear, consistent, historically documented pattern of how wealth is preserved and destroyed when economies break. If one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more of this clarity, and I will see you in the next one.